On July 15th, the DTCC processed its first ever production trades of tokenized US securities, real stocks, real ETFs, real treasuries held at the depository trust company, converted into tokens and used in actual live transactions. And Chainlink was right in the middle of it. If you've been following this channel for a while, you know we've been tracking the DTCC and Chainlink partnership for years, from the smart NEV pilot all the way to the collateral app chain. Today, at all of that groundwork turned into something you can point to and say, this actually happened in production with real assets. So let's break down what the DTCC did, how Chainlink fits in, and why one specific trade involving JP Morgan and the CME Group might be the most important part of the whole announcement. So quick context for anyone newer to this, the DTCC is the post-trade backbone of the American financial system. When you buy a stock, they're the ones making sure it actually settles and ends up in the right hands. In 2025 alone, their subsidiaries processed $4.7 quadrillion in security transactions. That's quadrillion.
Quadrillion.
With a Q.
Quadrillion.
Quadrillion.
That's right.
Their depository arm custodies about $114 trillion in securities. So when this organization does anything with blockchain, it carries a different weight than a startup running a testnet demo. And what they did on July 15, a few days ago, was take securities held at DTCC or DTC and convert them into tokens, what they call digital twins, which were then used in multiple real trades on-chain. According to the DTCC itself, this was the largest tokenized production initiative ever in terms of breadth of use cases, asset classes, and number of participants. More than 30 firms took part: BlackRock, JP Morgan, Goldman Sachs, Vanguard, State Street, Citadel Securities, the New York Stock Exchange, Nasdaq, CME Group, Societe Generale, Microsoft, Circle, Ondo Finance, and of course, Chainlink. That participant list reads like a map of the entire financial industry, from asset managers to exchanges to market makers to the infrastructure layer underneath. The trades themselves covered a surprisingly wide range of activity: collateral pledging, securities lending, treasury and repo delivery versus payment trades, equity DVP trades, equity delivery versus delivery, straight token transfers, and central counterparty margin workflows. These are the core plumbing operations of capital markets, and every one of them ran with tokenized versions of real DTC-held securities in a production environment over the course of several hours. One more detail that matters a lot: these tokens keep the same investors' protections, entitlements, and ownership rights as the traditional securities that they represent. You can convert between traditional form and the tokenized form. So a tokenized share here is legally the same thing as a share sitting in custody. That solves one of the biggest hesitations institutions have had about tokenization, because nobody wants to hold a token and then discover it's ambiguous what they actually owe. Now, let's talk about the trade that stood out the most. JP Morgan tokenized shares of the Invesco QQQ ETF, one of the most widely held index funds in the world, and posted these tokenized shares as a collateral to meet margin requirements at CME Group, the largest derivatives marketplace on the planet. Think about what that means in practice. Historically, margin collateral at CME meant cash, treasuries, or a short list of approved assets. Now, a tokenized equity ETF sat in that role. In production, JP Morgan didn't have to unwind positions or move cash around to meet a margin call. The tokenized collateral moved on-chain instantly while keeping all the legal rights of the underlying assets or shares. And the connective tissue for all of this was Chainlink. The cross-chain interoperability protocol, CCIP, and the Chainlink runtime environment handled the movement and verification of those tokenized assets across different blockchain environments. Because here's the thing, this event didn't happen on just one chain. The conversions ran on Besu, which is DTCC's private network under the Linux Foundation Decentralized Trust umbrella, and on Canton, which is a public network. DTCC calls this their multi-chain strategy built for resilience, scalability, and choice. And the moment you say multi-chain, you need something that lets assets and data move securely between those different environments. And that's exactly the job Chainlink has been building towards for years. If you watch my video on the collateral app chain back in May, this will feel familiar. That's when DTCC integrated the Chainlink runtime environment into their collateral platform, covering pricing, valuation, margining, and settlement. And at the time, it was an infrastructure announcement. It was important, but still abstract. Now, 2 months later, that same infrastructure carried real trades from some of the largest institutions on Earth. The pattern with Chainlink and DTCC has been very consistent. First on a pilot, then integration, and now full-scale production. Smart NAV in 2024 tested bringing fund data on-chain with JP Morgan and BNY Mellon. The collateral app chain in May built the rails. July 15 put the actual traffic on those rails. There's also a regulatory piece here that deserves a little bit of attention. About 7 months before this event, DTC received a no-action letter from the SEC, authorizing it to operate a tokenization service for real-world assets in custodies. That letter is quietly one of the most important documents in this whole story, because it means the largest securities depository in the world can tokenize what it holds without regulatory ambiguity hanging over every single transaction. The industry working group behind the service has grown past 100 members and partners. And all of this is a warm-up. The full DTCC Tokenization Service launches officially in October 2026. That's when DTC participants will be able to convert securities between traditional and tokenized form as a standing service, deliver those tokens to wallets of their choice, and tap into new liquidity pools. Frank Lasala, DTCC CEO, said the service will institutionalize tokenized markets on day one. Coming from the organization that settles essentially the entire US securities market, that's actually a statement with real infrastructure behind it. So what do I take away from all of this as someone, I guess, holding Link or watching Chainlink unfold and watching the tokenization space closely? Well, 3 things. First, the debate about whether tokenization will happen is over. When BlackRock, Goldman, Vanguard, and the DTC run production trades together, the question shifts entirely to how fast it scales and who provides the infrastructure. Second, Chainlink keeps ending up in a room where these decisions get made. The DTCC could have picked anyone to handle cross-chain movements and verifications for its event, but they picked the same track they already integrate into the collateral app chain, which I guess makes sense. In institutional finance, once you're embedded in production infrastructure, you tend to stay there, because ripping out working plumbing is not only expensive, but it's very risky. Third of all, keep your expectations honest on timelines. A production event with 30 plus firms is a milestone, and yet it's also still very early. We don't have ongoing volume numbers yet, and October launch will tell us how quickly this moves from milestone to routine. The direction is clear though, and the pace has picked up noticeably this year. I'll be covering the October launch in depth when it happens, so if you want to follow how this plays out, subscribing helps a lot. Let me know in the comments what you think matters more here, the CME collateral trade or the SEC no action letter, because I generally think that it's a good debate. Anyway, thank you so much for watching, and I'll catch you in the next one. Cheers, bye bye.